This is Advisorpedia's Power Your Advice podcast, and I'm Doug Heikkinen. Today we are joined by Matt Kaufman, who is the global head of ETFs at Calamos. Welcome to the podcast, Matt.
Thanks for having me. Good to be here.
Can we start by having you tell us a little about yourself, your journey to Calamos, and what being global head of ETFs means there?
Sure. I'll try to keep it short. I started in my career about 23 years ago or so. I started at PowerShares in the early days. We were just getting off the ground in the ETF space. The ETF itself was only about, say, 7 or 8 years old then. The funny story that we would tell, or that we like to tell, is that we got our exemptive relief from a larger asset manager in Chicago, and they basically made the comment that we don't think there's any room for growth in ETFs anymore. The S&P 500 is taken, the NASDAQ's taken, the Dow's taken, and so we don't know what else to do. We felt differently. We thought there was a lot more room for growth in ETFs, and turns out that was the correct assumption. We built the smart beta ETF space there at PowerShares, taking a lot of institutional type strategies and bringing them into the ETF world. Back then the challenging educational component was teaching advisors and teaching investors that you didn't just have to market cap weight everything in ETF land. You could do it differently. And that sounds a bit archaic now, but that was where we were back then. After PowerShares sold to Invesco, I went to an actuarial consulting firm. It sounds a little bit, coming out of right field saying it, and it felt that way doing it, back then. But the head of that group said, I have all the actuaries I need. I want to build funds out of our risk management strategies. And we had just built over 100 ETFs. So we know how to do that. So we went over, and a couple of us, and started building funds out of the hedging strategies that we were doing on the balance sheets of life insurance companies. So learned an insane amount about futures and hedging and options, and learned what makes a balance sheet work for life insurance companies. You think back to the time frame, that was 2010. Interest rates were near zero, if not at zero. And the value proposition that insurance companies and a lot of banks could provide was also very low. You couldn't get good guarantees from variable annuities. You couldn't get good participation rates on your fixed annuities or your capital protected notes. So it moved that whole insurance segment and the banking world as well into a risk sharing model, where rather than principal protection, you'd get something less. You would get a buffer on the market, a partial principal protection level. So I was the president of our broker dealer at the time. And what we've found is that you could deliver that way more efficiently with options than you could with a balance sheet. We did not need a balance sheet from an insurer or bank to replicate a partial principal protection level on a market like the S&P 500. So we developed some intellectual property that did just that. We developed some buffer strategies. This was about 2016. We delivered that into the market a few different ways. We gave it to some insurance companies for their variable annuity books, gave it into a UIT provider, and then gave it to an ETF client to build the first defined outcome ETFs in the market. So we built that space in 2017. That's been growing tremendously. I started at Calamos about 2.5 years ago. Calamos has been doing these types of payoff profiles for 40 years. They're the largest convertible manager in the country, second largest globally. A convertible looks very similar to a payoff profile of an option strategy, largely because it incorporates options. You get the upside of a company's stock. You're tied to the upside. You've got a call option on that. And then on the downside, you're tied to the bond. And so, being able to talk to John Calamos Sr. and seeing the parallels between the things that we were building in the options space and the things that he had been doing for the last 45 years, and said, we want to build into the future. We're doing private credit. We've got hedged equity strategies. We want to build an ETF line. So it was a great time and an opportunity to come over and basically take what Calamos has been doing for 30 or 40 years and use new tools, use the tools that advisors were looking for, build it with ETFs, use options. We just built an income ETF on Autocallables, which uses swaps. We can talk about that. But that is the last 23 years, and it's been a fun ride.
It sounds like it. The derivative income category has grown significantly. Can you help us understand this trend and where autocallables fit in?
Yeah, that is a massive space. Was fortunate to be part of the group that built the first covered call ETF. The first buy rate ETF was a PowerShares ETF. I believe it was about 2008 we launched that. Not many people bought it. I don't think they quite knew what it was back then. Fast forward 10 years and you see almost 300 billion in assets tied to options-based strategies in the ETF world, largely as a result of the SEC rule. You have 6011, and then you had a derivatives rule that followed, which allowed for the efficient delivery of options-based strategies in an active framework. It's just, you say the word active, which in ETF land just means it does not track an index. It's not a passive index tracking product, but a lot of active ETFs in the market today, a lot of them are options-based. In the derivative income world, you have covered call strategies in the ETF side. It's about $115 billion space. It's very large. You can think of the JEPIs, JEPQs, different types of covered call strategies that will sell some upside, collect a coupon or collect some income for that. And then you hope the market doesn't go down so far to eliminate the coupon that you've just taken on or erode that coupon. So in the structured note world, those are bank products. Derivative income also happens to dominate, but it does so by way of a product called the autocallable. So the autocallable, you can think of that like a bond, but whose par value, whose principal and coupons are tied to the equity markets instead of credit duration or some other traditional bond factors. So that auto callable space has grown tremendously. It also is about $100 billion a year market. There's about $100 billion a year in issuance in the structured note space, all tied to auto callables. There's a thirst for income and there's a thirst for differentiated sources of income. A lot of investors have seen interest rates go from 0 to 5%, come back down a little bit. There's a lot of uncertainty in the interest rate environment, even who's actually controlling those levers. I think right now we're curious, where Trump is going relative to Powell and if that's even his decision. But nonetheless, there is some interest rate uncertainty, and that's causing a lot of investors to start to look for income that's differentiated from those traditional bond risks.
What are the key risks advisors should understand about autocallables?
Yeah, that's a great question. So you are taking on deep equity tail risk in exchange for a coupon. So those are the risks. That is the risk you're taking on. So if you think of a covered call strategy, with which a lot of advisors might be familiar with, you sell off your upside, you collect a coupon, hoping the market doesn't erode that coupon as it falls. Here, you can think of it like a bond. So again, you're tied to the equity markets not falling too far. There's a couple of terms that might be new to some of the listeners here. A barrier would be a coupon barrier and a maturity barrier. So instead of terms like buffer or floor, a barrier simply is a down and in put level. So if you had a barrier option on the S&P 500 set at -20, that would mean that if the S&P 500 fell by 20 or more, then you knock in and you lose that amount. If the S&P 500 falls by less than 20, then you don't, and you keep all of your money. So in that instance, if the S&P was down 15%, you would still get your par value back. You'd get your coupon. So the barrier is an important term relative to auto calls. That's how you would size and understand your risk. So if you think of maybe a 40% barrier that's tied to a coupon, let's say your coupon's 12%, you will always get that coupon every month so long as the reference index is not down below that barrier level when you observe that coupon payment. And then if it's a 3-year note, same is true at maturity. If that level is not below the barrier at maturity, you get all of your principal back at maturity. But the odds are, as the name implies, you'll get called away early because there's an auto call feature inside these products. So that is an operational, I would say, risk. What we've heard from advisors, also an operational nightmare. A lot of times they'll enter into auto callable notes. They'll buy a few different ones from different banks. They'll get a decent coupon for that. A few months later, they'll get called away. If the index appreciates beyond the call level, they'll get called away. They get their money back. they get that final coupon and they have to go shopping again. And it's a very arduous process. But what we just did with the auto callable income ETF, CAIE, is we put all of that into a single ETF that's just very automated. So it's really hitting the easy button for advisors, was using their words, not mine, but I'll steal that marketing term.
Yeah. So autocallables have traditionally been limited to institutional investors. Your Calamos autocallable income ETF changes all that. So can you talk more about it?
Yeah, that's right. So what we've done is we've collaborated with two other high quality groups, JP Morgan as a swap counterparty, and then Mercube, which is a leading custom index provider who does a lot of indexes for structured products, for a lot of ETFs. We've used them on the ETF side as well. I've known the CEO there for quite a long time. And so we collaborated together to solve this auto callable problem for advisors in the market. uh, our goal was to deliver the auto callable space in a way that was transparent, efficient. It just was a laddered exposure, diversified out the maturity risk, diversified out the coupon risk. So what we worked on and what Mercube built was a laddered index that replicates the performance of a weekly issuance of an auto call. Each one of those auto calls, there's 52 or more in there, have a 5-year term, a 1-year non-call period, a 40% coupon barrier, a 40% principal maturity barrier, and they're all tied to a US large cap vol advantage index that Mercube has also issued. So each of those auto calls is tied to the performance of that underlying index, which has been optimized for auto callables. There's about $3 billion worth of notes currently in the market tied to that Mercube vol advantage index, largely issued by JP Morgan. We have collaborated to build all of that inside of an ETF wrapper. So you're not just getting exposure to one auto call, you have 52 or more of them entered weekly, laddered exposure. So instead of betting everything on a single entry point or a single maturity point, you're diversifying across time, and everything is happening inside that index. And we just trade that index on swap with JP Morgan. So it's a remarkably efficient experience. When you do this inside of a swap or inside an index that we trade on swap, it's remarkably tax efficient as well. So about 3%. Well, I'll tell you the coupon. I left the good part out. So right now, the average weighted coupon of that laddered index is about 14.5%. So that's an annualized coupon. And from a tax perspective, in our ETF, we hold a lot of collateral, a lot of treasuries. So we'll have to distribute about 3% of that as ordinary income. The other, 11% or so, our goal is to distribute that as return of capital. So there's good rock and there's bad rock. Bad rock would be giving you your money back to you, just returning your own capital to you. Good rock would just be treated as return of capital. So what that means is your coupons are largely going to be tax deferred, and then it's going to reduce your cost basis. So if you buy in at 25, collect some income off of that, maybe your cost basis goes down to 15. Then when you go to sell, you'll just pay long-term capital gains on that difference between the 15 and whatever you sell at. Maybe you sell at 25. The other interesting thing we're seeing advisors do is using this to generate nearly tax-free income for their older clients, older investors. And then the clients are going to bequest those shares to their heirs. And when those heirs get the shares of CAIE, they'll get a step up in basis and have no cost or no taxability on those shares. So what the advisor's done is created largely tax-free income for their older clients. And then when they bequest those shares, there's no taxable event.
That's great. How else does CAIE fit into a portfolio, and what are the applications that you see?
Yeah, so because these notes mark to market with an underlying equity index, you'll see volatility in the NAV stream that looks a lot like the S&P 500, maybe a little bit higher beta, slightly higher volatility. So that's important to note, that your experience in the fund is going to look a lot like an equity experience, but you're going to have a coupon. You're going to have a high, stable coupon for that. So the way that a lot of folks are thinking about this inside the portfolio is, there's a big desire for income. So you might swap out some of your traditional equity exposure and now turn that into an income payment. If you think we're in a range-bound market over the next several years, or maybe you don't think the market's going to go up more than 14%, this would be a way to lock in, that coupon. And as long as you don't hit a severe drawdown in the market, those coupons are going to be there. So people are trading equity exposure for this type of income. Some might think of it like a high yield bond replacement. Maybe you get 7 to 8% yield from a high yield bond, and you have default risk in a severe sustained drawdown in the market. Whereas you're trading that default risk for just equity market tail risk. So a differentiated risk source. Some people are pulling from that bucket as well.
Yeah, last one for you. How might CAIE adapt in response to shifting interest rates and/or market volatility in the next 18 to 24 months? It's crazy out
Sure.
there.
We're going to get a little bit in the weeds here, so hopefully everybody stays with us. But we have the reason that I personally love the Mercube US Vol Advantage Index is it's been optimized and built specifically for auto calls. So if you think about your covered call strategies, going back to those ETFs, you sell a call, and the coupon or the premium you collect is largely based off of volatility in the market. So it's variable. 1 month you might get 1%. 1 month you might get, 0.5%. It all depends on volatility. So in our ETF, the reference index has a stable volatility. And so that allows us to stabilize that measure inside of our options pricing. So every week when a new note is going into the ladder, it's largely has a similar coupon as all of the other notes because it's working off of the same parameters. So you're tied to interest rates a little bit. What we've seen is about 8 to 10% over a 1 to 5 year corporate bond rate. So that's where you get to about a 14% coupon right now. If rates go to zero, your coupon might go down a little bit, but you're not going to go down, as much. Maybe you're in the 7 to 8 range, just, making an assumption. But what I love about this particular product is it does not rely on volatility movements like other autocallables do or like other derivative income strategies do.
Matt, this was all very well explained. Thank you so much for joining us and best of luck.
Oh, appreciate it. Thank you so much.
To learn more about CAIE and all that Calamos has to offer, please visit calamos.com. We are on all social media platforms at Advisorpedia. Please give us a follow. For our producer, Tori Miller, and everyone at Advisorpedia, thank you so much for listening.